Wow, what a day, huh, guys? It's interesting. I've been doing this for 30 plus years and I've been through so many days like yesterday. The only thing you could do is look back and look at the charts and look at the levels and then look at your positions and look at what you did right, what you did wrong. How could you have saved money? How could you have made money? How could you have been opportunistic? Did you follow your rules? Did you follow your process? And it's just so easy to see the next day when you look back, like, oh my God, all I had to do is sell it here and short it there. All I had to do is wait for this level versus no man's land. All those things that go through your mind either the night of or the day after. And then what you do is you just write them down and you learn from it and then you move on. At this point, yesterday's behind us. The trade changed. There was a lot of complacency out there. There was a lot of battlegrounds. Like, the conversation was, with the poor AD lines, where they were selling everything but keeping some Mag 7 up and this and that, who was going to win? Was Tech going to hold up and were we going to be in some kind of cruise control into year end? Or was the underlying weakness going to roll us over with Tech pulling back and breaking key levels? And although everyone kind of knew the Fed would be hawkish, sometimes, what was that movie, Reality Bites? The reality of the situation is when the S&P is up 26, 27%, you can't have an accommodating Fed. You can't have a Fed that's going to say, hey, I'm going to cut 100 basis points next year when the S&P in 2 years we're up like 40 something percent. So the only way the Fed gets accommodative is if all of a sudden you get in a corrective stage, sentiment gets poor, and then all of a sudden like, oh, now we can cut because the market's taking rates lower. And they say that they don't watch the market, but they do. It is what it is. So this was yesterday during the day. I'm like, we had a red dog reversal where it went above a prior high, didn't hold it, and then took out 602.80. So right there, that was the level. We took out the 21-day. Thousands of times I've written ebooks about when you're below the 8 and 21-day, you have to adjust. You're no longer in the same type of trend which we've had. I said to myself, hey, maybe we hold 591, which would be the 50-day. So that's when I had my major loss yesterday. I started buying a little bit ahead of 591. It blew through 591, went to 585, went down another 5 points. I had way too much spies. Instead of making and being at the highs of my year, I lost a bunch. Always read the language because the language kind of tells you what happened. So now I approach today with so much less on. So I'm okay with that. The trade changed. I'll move forward. Some people are like, oh, well, just buy the dip. Well, you don't know where this dip's going. If you trade for a living and it's December 19th, you're like, I'm just going to buy the close. You could have downside follow through. Last night, the spies are trading at 583, and then you have a gap down to the 100-day. Key stocks went to the 100-day. So if you're just buying this because buy the dip, that's the way you do it for 100 years. Okay, but you could have continued to buy the dip, lost a lot of money, and who knows if we were going to bounce here. So what am I thinking now? So here is the spies. Okay, you're getting a bit of a bounce back. So it's up 260. Bottom line is you're bouncing up 270. So we're up a little bit. So now you use retracement rules. I posted those cheat sheets to retracement rules to figure out how much control does this candle have? Meaning, what type of bounce are we going to have? Was this the get all the fluff out, get all the complacency out, get everyone negative, then all of a sudden we rebuild and we grind back higher into the end of the year? Or does the rally get sold for continuation to the down move? So the question is, what type of bounce back do we have? So if right now we bounce to 591, which is another $2 from here, overlay your retracement, that's probably a 0.382% retracement, but that would be a pretty feeble rally if we get here and then go red. If we get here, pause a little bit and then push up a little bit, then you really have 596. That would be where if the sellers want a continuation move to the downside into the end of the year, they probably don't let the bulls retrace and reclaim 596. So in my head, I'm putting out plan A, B, and C. So one plan is maybe it gets to 591, but you don't just short right here. Some guys are like, I'm going to short the open. The trades change. We're going lower. We're going to be at least at 576. But if you short 589, which is really no man's land, it could go 2 points more in your face. And then all of a sudden it pushes through. You're like, wow, I just lost 10, 15 grand and get out of the way. And then 11:30, it reverses. So you have to figure out, how involved you want to be. To me, again, this 591, 596 are two levels that I'm going to be watching. That if you play a bounce, maybe there's room to there, but make sure you're not buying there. And if you're looking to retrace or short a bounce, these are two spots. The best scenario would have been if we were opening in the hole a little bit. You could buy Versa 5 15-minute low in the hole, Versa level, so your risk is defined, and then you see where we could bounce to and you make some money. So at this point, those are your levels. Here's the low. Here is where it could potentially bounce back and get rejected. And then this would be a big line in the sand moving forward.
Sign up for Scott's free newsletter by scanning a QR code or clicking on the link in the profile bio.